Hi students, how are you? Can you hear me? I'm fine too. Okay. As you know that today we will continue the investment topic of investment appraisal, and in investment appraisal the technique which we are discussing is net present value. We discussed the basics of this technique in the last class, the basic concept that the difference between the present value of cash inflows and the present value of cash outflows is known as net present value. And if the NPV is positive, then the project should be accepted. We also discussed the advantages and disadvantages of net present value in the last class. And I told you this is the best technique in financial management in our syllabus, which can be used for appraisal of investment opportunities. Now, we will discuss this technique in detail. Now, in exam, there will be a major question from net present value. And in exam, the net present value, in a long question in a section C, we have to prepare the pro forma to calculate the net present value. The first element in that pro forma is year. Years mean in year you can say that we are discussing basically the term, the length of the project. It will start usually from 0, year 1, year 2, year 3, and year 4. It depends on the length of the project. If we have a 5-year project, then there will be year 5 as well. If it is a 6-year project, there will be year 6 as well. But I'm assuming that the project for which we are preparing the pro forma is 4-year project. First of all, we usually take the initial cost, and this initial cost usually invested in year 0 immediately. So a specific amount of initial investment will be taken as outflow in a year 0. Usually there is no investment in year 1, 2, 3, and 4. If there is any further investment after year 1, year 2, then obviously there will be additional investment as well. But usually you will see that investment is done immediately in a year 0, and that investment is relating to purchase of property, plant, and equipment, long-term investment, capital expenditure, and that investment is taken as negative cash outflow in year 0. After that, we will be having the sale And obviously, we will consider only cash sale. The cash sales in year 1, year 2, year 3, and year 4. Working 1. Now, working 1. How to calculate the sale? The units will be given, it will be multiplied by sale price per unit. Usually, the sale price per unit is given in current price terms. Current price terms mean we didn't consider the increase in sale price in future. The sale price will be given in current price terms. That means the sale price will be given in the terms of year 0. Now, what will be the sale price in year 1, year 2, year 3? For that purpose, we will multiply this value with 1 plus G. G is, you can say G is the inflation rate or growth rate in a sale price raised to power positive N, and we have a relevant sale value in our pro forma. If we are talking about year 1, N will be 1. If we are talking about year 2, N will be 2. If we are talking about year 3, N will be 3. And that outcome will be written in sale column. Obviously, we will be having the Excel. I will also show you in a practice that how we will perform the calculation in a spreadsheet, but that is the concept which I am trying to convey you. Now, for example, let me perform you a little calculation. For example, we have year 1, 2, 3, and 4. In exam, we will be given with the units 100, 120, 80, and 90. And sale price per unit, for example, is $10. And that sale price is in current price terms. And the growth in a sale price is 4%. So when I will calculate the sale price, the sale revenue for year 1, I will take 100 into $10 into 1.04 raised to power 1. When I will calculate the sale revenue of year 2, 120 into 10 into 1.04 raised to power 2. For year 3, 80 into 10 into 1.04 raised to power positive 3, and so on. For the year 4, 90 into 10 into 1.04 raised to power 4. Okay, this is how we will determine, usually we determine the sale revenue in the NPV pro forma. You get it? Then after the sale revenue, we have variable cost. Variable cost, the cost which depend on the level of activity. It will be taken as an outflow here. Now, how we will determine it? Working number 2. Now, working number 2. We will take the same formula, we will take the number of units into variable cost per unit, and again it is usually given in current price terms, and multiply by again 1 plus growth raised to power n. Now, for example, we have a same data and the variable cost is $6, and the growth in a variable cost, let's assume, is 5%. So what we will do for year 1, the variable cost will be equal to 100 into $6 into 1.05 raised to power 1. For year 2, 120 into $6 into 1.05 raised to power 2, and so on. So this is how we will determine the variable cost. Now, after the calculation of the variable cost, if we want, there is no requirement, but if we want, we can net these two values, and the outcome will be the contribution. So we will have the contribution for year 1, then year 2, year 3, and year 4. The difference between sale and variable cost. We have a contribution. You get it? Do people get this point? After the contribution, we will consider the incremental fixed cost. Incremental fixed cost. Incremental fixed cost means the fixed cost which is due to the project which we are going to do. If we have already in centrally allocated fixed costs which are irrelevant, we will not consider those fixed costs in the decision making process. We will consider only relevant fixed cost, incremental fixed cost which is due to the project, which is incurring due to the project. That fixed cost will be taken, and the relevant fixed cost will be deducted from the contribution. And after that, again, we will net the contribution and fixed cost, and we will be having the cash flows before tax. Cash flow before tax. In year 1, year 2, year 3, and year 4. Contribution minus incremental fixed cost. Any question? Then we will apply the tax. The rate will be given, for example, 30%, and we will calculate the 30% of each cash flow in year 1, year 2, year 3, and year 4. But the point need to be discussed here for the tax purposes. Tax adjustment. Tax adjustment can be in two scenarios, or two types of scenarios may be tested in a tax. One is same year, and the second is tax with 1 year delay. Same year mean that tax of the year 1 will be paid in year 1, tax of a year 2 will be paid in a year 2, tax of a year 3 will be paid in year 3, and the tax of the year 4 will be paid in year 4. So year 1 tax will be paid in year 1, year 2 tax will be paid in year 2, and 1 year delay means that the tax relating to year 1 will be paid in year 2, and tax of year 2 relating to year 2 will be paid in year 3, and the tax relating to year 3 will be paid in year 4, and so on. The tax of the year 4 will be paid obviously in year 5. This is with 1 year delay. Now it totally depends on a question. There will be clearly mentioned that when the tax should be paid, that there will be clear indication. But we should know that same years mean the tax will be paid in a relevant year, and the 1 year delay means the tax of the year 1 will be paid in a year 12. That is known as 1 year delay. It is also known as arrears. Tax will be paid in arrears. Now, in this scenario, in this pro forma, I am assuming, just for understanding purpose, I'm assuming that we will pay the tax with 1 year delay. So if the tax is with 1 year delay, that means no tax will be paid in year 1. The first tax will be paid in year 2. And this tax is basically the tax on year 1 profit, and it will be paid in year 2. And the tax on year 2 profit, on a year 2 profits will be paid in year 3. And the tax on a year 3 profit will be paid in year 3. And for the tax purposes, project is 4 years, but for tax purposes, I have to include another year, which is year 5, just for tax purposes. Because the tax of the year 4, will be paid in year 5. That is known as 1 year in arrears, or tax is paid with 1 year delay. Okay, you get it? Then after the tax, yes, obviously, Nabia, obviously you have to learn the format as per the format I am telling you. This is, you can say this is a standardized format. After the tax, we will determine the capital allowance. There is a concept of capital allowance. Now, what is capital allowance? It is relating to tax. This is relating to tax, capital allowance. Have you people learned, studied the F6 paper, tax paper in your ACC journey? Okay, then it will be very easy. Capital allowance means, capital allowance, when we say the capital allowance means the tax relief on taxable depreciation and on balancing allowance or tax charge on balancing charge. What is balancing allowance? Can anyone describe the balancing allowance? Balancing allowance? Balancing allowance means tax relief on loss of disposal. If we have a loss on disposal of the asset, then we will get an extra tax relief. And balancing charge means if on the disposal of the asset, if we have a gain on disposal, then obviously on that gain we have to pay the tax. Now, for example, let's assume a data. Let's assume we have initial cost of $100,000. Tax depreciation is on 25%. Reducing balance method. Scrap value is 5,000. Useful life equal to 4 years, and tax is equal to 30% with 1 year delay. Now we have to calculate the capital allowance. So how we will calculate it? In year one, let's do first of all in year one, carrying value, depreciation, and tax. In year one, the cost of the asset was 100,000. Depreciation is 25%. So it will be 25,000. And the tax rate is 30%. So the tax relief will be $7,500. So for the year one, this 7,500 is the capital allowance, tax relief. Okay, but this is with 1 year delay. So with 1 year delay means this tax relief will be available in year two. Tax relief will be available in year two. So no capital allowance relating to year one will be in year two. Same assumption will be used in a capital allowance which we have used in a tax calculation. You get it? So the year two capital allowance will be, the carrying value will be 75,000. Will be 75,000. Now please take the 25% of 75,000. %25 of 75,000. $18,750. Now please take the 30% of 18,750. 5625. And this will be in year three. So 5625 in year three. You get it? Year two relief will be in year three. Now do calculate the year three and year four. Do the calculation and let me know. Okay. So the carrying value for year 3 will be 56250 and 25%. It will be 140 and into 30%, it will be 421.9, and this relief will be available in year 4, 4,290. You get it? And then the final in a year 5, in a year 4, sorry, in a year 4, the carrying value will be 56250 minus 14062. It will be 42188. You get it? Now, from this value in the last year, from this value, you will deduct the residual value, scrap value. And the scrap value was $5,000. So the $5,000 will be deducted, and after the deduction of the $5,000, we have a balancing allowance. We have a loss on a disposal, and that loss on a disposal is 37,188. This is a loss on disposal, also known as balancing allowance. So we have a balancing allowance of 37188. Now we will take the 30% of this balancing allowance, and 30% of this is 11,156, and this is a balancing allowance on year 4, but the relief will be available in year 5 with 1 year delay. So 11,156 will be the relief in a year 5, relating to year 4, but the relief will be available in year 5. You get it? Any confusion? Okay. Then we will take the residual value, scrap value, and that scrap value will be taken as inflow in a final year of the project, which is year 4. Year 5 is not the final year of the project. This is just for tax purposes. Year 5 is just for tax purposes. The final year of the project is year 4. So the residual value will be taken as inflow in a year 5. Then at the last, we will take, or we will adjust working capital. Working capital. Now, what is working capital? Let's talk about it. Normally, the working capital is known as current asset minus current liability. The difference between current asset and current liability is known as working capital. And for example, in current asset, we have receivables, we have inventory, and in current liabilities, let's assume we have trade payables. When we sell on credit and we have to build the inventory, obviously the cash will be tied up because first we made the inventory, maybe we take 20 days to make the inventory and sell it, then the credit customer is taking 30 days. So the total days of investment in a working capital is 50 days. Out of 50 days, we have a support from trade payables for 25 days. So on a net basis, 50 minus 25, we have to arrange the finance for 25 days. So we can survive in a short term. So that investment which we have to make to operate the cash operating cycle of the business, that is known as working capital. That is known as working capital. Working capital usually initially invested and subsequently we adjust the working capital. And at the end of the business, when we close the business, all the working capital which we have invested in a business will be recovered from the business. Okay, because when the business will be closed, there is no need for further investment in a working capital. So we will recover the working capital from the project. Now, for example, how we will adjust the working capital? Let's assume he will tell us the adjustment will be given like this, that we need working capital of $1,000 immediately from the start of business and every year there will be increase of 10% in working capital. Okay, such adjustment will be mentioned in a question. So we need $1,000 immediately. So immediately means that we have to invest the working capital immediately in year 0. So $1,000 will be invested immediately in a year 0. In a year 0 in working capital. Then in every year there will be a 10% increase, and we will take the incremental working capital. So in year 1 we need 100 further working capital. So at the end of the year 1, now we have total 1100. Now we have total 1100 in working capital. 1000 was initially, then $100 was subsequently invested. Then in a year 2, we need 110 further working capital, because there will be an increase of 10% each year in a working capital. So the total working capital which we have invested till year 2 is 1000, then 100, 1100, then 110. So now we have total $1,210 invested in a working capital. Then in a year 3, again we will take the 10%, and this time it will be 121. Okay, 10% of the total accumulated working capital. So this is the total working capital which we have invested in a project. 1000, then 100, then 110, then 121. So total working capital of 1,331 has been invested in this project till the end of the 3rd year. Now the 4th year is the last year of the project. So each penny which we have invested in a working capital will be taken as an inflow in the last year of the project, because at the end of the project, every penny which we have invested, every dollar which we have invested in a working capital will be recovered. This is the assumption, and we will use this assumption in our calculation. Okay, so 1000 was initially invested, then in every coming year there is increase of 10% of the working capital. Then at the end of the year, every dollar which we have invested in a working capital, we will recover it and we will take it as an inflow. You get it? Now, then we will calculate the net cash. In year 0, usually we have negative value. Negative value. Then in year 1, positive, usually maybe positive, 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 positive. Okay, or might be negative as well, but for profound purposes I'm assuming the positive cash flows. And then these net cash flows will be discounted. We will use the rate of return. It will be given in a question, that is also known as WACC. WACC means weighted average cost of capital. Weighted average cost of capital, it will be given in a question. We will use that rate of return. For example, that is 10%. Have a discount factor. Year 0 discount factor is 1, 0.909 for year 1, 0.826 for year 2, 0.751 for year 3, 0.683 for year 4, and 0.621 for year 5. And the net cash flows will be discounted, will be multiplied by with the discount factor, and then we will get the present values. Present values of the cash flows. And at the end, we will net the present values, present value of cash inflows and present value of the cash outflows, and we get the NPV. Positive or negative. If it is positive, then project will be yes, we will accept the project. If it is negative, we will say no to the project. You get it? Any question? Other students, any query, any question? Okay, now some points to be noted. We will not consider in this all calculation, we will not consider any irrelevant cash flows, will not be considered in a calculation of net present value. Non-cash items like accounting depreciation, provisions, bad debts, bad debts or debtors, which are non-cash expenses, we will not consider those items as well in an NPV calculation. Number 3, interest payments and dividend payments will also, we are not going to consider the interest payment and dividend payments in the net present value table. Okay, so these are the 3 items which we will not consider in the calculation of net present value. Just remember, these are very important ones. Okay, now look at this question. We have a question. I'm performing the calculation of this question from the past paper, so we can uh, uh, better understand the performer. Okay. So for in a class, we are using this question to understand the performer which we discussed for the calculation of NPV purposes. Please read the question. Read the question carefully. I'm giving you 5 to 10 minutes. Read the question very carefully. Then I will perform the calculation on a spreadsheet, and then you can relate that thing with the performer. Okay. Please read the question. Okay, have you read the question? Okay, I will perform only those function here which you people will use on ACCA practice platform. Okay. We have here 0, 1, 2, 3, and 4. We have 4-year project. So first of all, we have initial cost, and the initial cost okay, this is the initial investment, 5 million US dollar, 5 million US dollar. So we will take here the 5 million and it will be taken as outflow. And let me remind you, we are taking 30 common. We are having 30 common in a question. 30 common. So I'm taking 5 million negative. Then I told you that we will take the revenue or sale, and now look at the data in a question. In the first year, we have $12,000. The sale price is $450 per unit, and read this line. This forecast before taking into account of the selling price inflation of 5% per year. So the sale price which is given in the data in each year, year 1, year 2, year 3, and year 4, these are without considering the inflation in a selling price. And as I told you that we will consider the inflation. So in a year 1, we have sold 12,000 units and the sale price is 450. And the sale price is 450. So as you know that we are taking 30 common, so equal into 12,000. We will just write 12 taking 30 common into sale price of 450. Sale price is 450 and multiply by 1.05. 1.05. 5% is the inflation rate, the growth rate in a sale price, and press the enter, and we have a sale of 5,670. You get it? Similarly, in a year 2, the units are 13 into 475. 13 into 475 into 1.05, this time raised to power 2. Then in a year 3, we have 10 into 500 into 1.05, and this time raised to power 3. And then we have year 4, and in year 4, the sale price is 570. Units are still same, into 570 and into 1.05, and this time raised to power 4. So this is the sale revenue. You get it? Yes, students, you get this? Then we have a variable cost, and in a variable cost, the inflation rate is 6%. Inflation rate is 6%. And these are the variable costs before considering the inflation. 260, 280, 295, and 320. So in the first year, variable cost equal minus 12 into 260 into 1.06. Units into variable cost per unit into 1 plus g raised to power n. So that is the variable cost for the year 1. In a year 2, it will be equal 13,000 into 280 and again into 1.06, but this time raised to power 2. Then equal into units, which are 10,000, and the variable cost is 295, and into this time 1.06 raised to power 3. And then again, in a year 4, the units are again 10,000. Variable cost is 320 into 1.06 raised to power 4. So this is a variable cost, and if we want to determine the contribution, we can do. It is not compulsory, but if anyone want, he can do. So equal sum, bracket open, select these, press the enter, we get the contribution. Then come to this corner and drag the cell, the formula will be automatically copy paste. And this function is available in ACCA practice platform as well. It will save a lot of time. You get this? Now the fixed cost. Fixed cost is 750, 750, and 750. And the inflation in fixed cost is 3.5%. 3.5%. So equal minus 750 into 1.035. Then equal, select this cell and again multiply by with 1.035. For year 3, equal, select this cell and multiply by with 1.035. And then again for year 4, select the cell of year 3 and multiply by it with 1.035, 3.5%. So we have a fixed cost, and now we have cash flows before tax. Equal sum and net the contribution with this fixed cost and copy paste it. We have a cash flow before tax. Now the tax rate is 28% with 1 year in arrears. One year in arrears means that the tax of year 1 will be paid in year 2. Then the tax of year 2 will be paid in year 3. And the tax of year 3 will be paid in year 4. And the tax of year 4 will be paid in year 5. Okay. Tax in arrears. You get it? Everyone? Then we have to calculate the capital allowance. And here we will perform the working of the capital allowance. So year 1, the carrying value was 5,000 and the tax is 24. Depreciation is 25% on reducing balance. Equal to 25 and the tax rate is 28%. So 350 is the capital allowance of year 1 and this relief will be taken in year 2. So 350 will be taken in year 2. In a year 2, the carrying value will be 5,000 minus cumulative depreciation, that is 3750, and the depreciation will be 25%, and the allowance will be 28%, and this will be taken in year 3. Then we have year 3. The carrying value will be 2812.5 multiply by with 25%, and the capital allowance will be 196, and it will be in year 3. Now we have a last year, year 4. In the last year, we will determine the carrying value first, equal minus this. So we have 2109.375 carrying value. Now the sale proceeds are, if you look at the sale proceeds are for 400. 400 are the sale proceeds with 30 common. The carrying value is 2109 is the carrying value, and the sale proceeds are just 400. So we have a balancing allowance of 1709.375, and the tax relief on this will be 478, and this will be considered in the 5th year, which is the tax year. You get it? Then the residual value of 400 will be taken here. Then the working capital, there is no working capital adjustment here. So now the net cash will be determined. 5,000, and in year 1, it will be equal sum, open the bracket, and from this cell to this cell, from E7 to E12, E11, you will select, put the enter, and then simply drag it, you will get the net cash. Now the rate of return or weighted average cost of capital is 13%. For year 0, it will be 1. For year 1, it will be 1 plus 13% raised to power minus 1. 1.1 plus 13% raised to power minus 2 equal to 1 plus 13% raised to power minus 3. 1 plus 13% raised to power minus 4. 1 plus 13% raised to power minus 5. we have the following discount factors, and now the present value equal this cell multiply by with this cell and simply drag it, you will get the present values, and here you can determine the NPV now. For NPV equal, again sum, select the bracket and select the present value of these cash flows and press the enter. You will get the NPV of 683 negative. This is negative NPV. So on financial grounds, now when we will write the comment, we will write that on the financial grounds, this project should not be accepted because the NPV is negative on financial grounds. Okay, on financial grounds, this project should not be accepted. Should not be accepted. But if we read the question, on the start of the question, it was stated that the project A is strategically important project and this project must be undertaken. So in the case where the projects are strategically important, then we do not go for the decision making on financial grounds. So if this project is strategically important, then on that basis, this project will be accepted. But on the financial basis, this project should not be accepted. But strategically point of view, this project will be accepted by the manager. You get it? Any question? Okay, then we will take a break. Now we will take a break of 10 minutes. After the 10 minutes, we will resume the class. Take a break. Okay, welcome back. We will discuss another concept which is relating to net present value. The concept is known as Fischer Effect. Just a minute. Just a minute. Fischer Effect. Now, what is the background of this concept? First of all, dear students, the cash flows which we may use in NPV have two types with the point of view of inflation. The real cash flows, and number two, nominal cash flows. These nominal cash flows, also known as money cash flows. Now, real cash flows means the cash flows without inflationary effect, and nominal cash flows mean the cash flows with inflationary effect. The cash flows in which inflation has been adjusted is known as nominal cash flows, and the cash flows in which the inflation is not adjusted are known as real cash flows. Now, similarly, the discount factor which we use to discount the cash flows, which is also known as rate of return, they are also have two types. One is known as real rate, and the second one is known as nominal rate. The real rate means the rate of return without inflationary effect, and nominal rate of return means the rate of return with inflationary effect. You get it? Real cash flows, nominal cash flows. Real rate, nominal rate. Now the point is, if we have real cash flows, then the discount factor which we will use will be the real rate of return. If we have nominal cash flows, then the rate of return which we will use will be the nominal rate. So the basis on which the cash flows are determined, on the same basis the rate of return will be determined to be used as a discount factor. You get this? Okay, now Fischer has a formula. Fischer give us a formula that is 1 plus M is equal to 1 plus R multiplied by 1 plus H. Now the M is nominal rate, R is real rate, and H is general inflation. Now if I tell you that the real rate is 10% and inflation is 3%, and I want to know the money rate of return, then we can use the Fischer formula. Now in Fischer formula, the M will be equal to 1 plus R multiplied by 1 plus H minus 1. So the M will be equal to 1.1, 1 plus 10% into 1.3%, 1 plus 3% minus 1. So what will be M? M will be 1.1 it will be 13.3%. So money rate is 13.3%. You get it? Similarly, if I tell you that M is 13.3%, inflation is 3%, and I want to know the real rate, again, for that purpose, we can use the Fischer effect. Now, in a Fischer effect, the R will be equal to 1 plus M divided by 1 plus H minus 1. So the R will be 1.133, 1 plus 13.3% divided by 1.03 minus 1, and you will get R equal to 10%. You get it? So what is the role of Fischer? Using the Fischer formula, we can determine the M and we can determine the R. And if we have real cash flows, we will use the real rate of return. If we have a nominal cash flows, we will use the nominal rate of return. But in both scenario, the answer, the NPV will remain the same. Now, for example, if I tell you that the real cash for year 1, 2, and 3 are 100, 110, and 115, and the real rate is equal to 10%, and let's assume the inflation is equal to 3%. So if I have a real cash flows, I told you that we will use the real discount factor, and the real discount factor will be 10%, and the discount factor of year 1 will be 1.1, raised to power minus 1. It will be 0.909 raised to power minus 2. It will be 0.826, and raised to power minus 3, it will be 0.751. $90.9, $90.86, $86.365. This will be the present value. Okay, in real term. But in a question, they ask us to use the nominal terms. In that case, we have to convert the real cash flows into nominal cash. And for that purpose, we know that the inflation rate is 3%. Inflation rate is 3%. So 100 into 1.03. So in nominal terms, it will be 103. For year 2, it will be 110 into 1.03 raised to power 2. So we have 116.699, and for year 3 we have 115 into 1.03 raised to power 3. So the third year cash flow will be 125.663. So we have inflated the cash flows with the 3% rate of return. So now we have nominal cash flows. So if we have nominal cash flows, then which discount factor which will be used? According to Fischer, which discount factor should be used? Real rate or nominal rate? Students, if we have a real cash flows, we use real rate. And if we have nominal cash flows, which rate of return will be used as a discount factor? Real rate of return or nominal rate of return? Nominal. And the nominal rate of return is 13.3%. If you remember this, we have 13.3% rate of return. So if we have 13.3%, then the discount factor will be raised to power -1. It will be 0.883. For year 2, it will be 0.779. And for year 3, it will be 0.688. So it will be 90.9. The second one, 116.699 into 0.779. It will be 90.86 almost, and it will be almost 86.365. So you can see that whether we use the real cash flow and real rate, or whether we use the nominal cash flows with the nominal rate, the answer will be same. Answer will be same. You get it? So it was the Fischer effect, the concept of Fischer effect. We will do the practice of these concepts later on. So the concept has been discussed. We have discussed the concept of NPV with an example, and now we have discussed the concept of Fischer effect. Now the last investment appraisal method is internal rate of return. Also known as IRR, internal rate of return. Now, what is the definition? Dear students, internal rate of return IRR is a rate at which NPV will be zero. The rate of return at which NPV will be zero is the internal rate of return. So we can describe it that the rate of return at which initial investment will be equal to the future cash flows discounted at a rate of return. So the rate of return at which if we use that rate as a rate of return, and that rate of return cause the present value of future cash flow. This will be the present value of future cash flows. Present value of future cash flow. The rate which caused the present value of future cash flow exactly equal to initial investment of the project. That rate of return will be known as internal rate of return, IRR of the project. If we talk about the formula of internal rate of return, internal rate of return is equal to A plus X divided by X minus Y multiply by A minus B. This is the formula. Here the A is equal to lower rate B is equal to high rate, X is equal to NPV at A, Y is equal to NPV at B, A low rate and B high rate. So this formula we can use to calculate the internal rate of return, and we will discuss this later on. Okay, but this is the formula as well to calculate the internal rate of return or IRR of the project. IRR of the project. Now, what is the decision rule here? What will be the decision rule in internal rate of return? Dear students, if internal rate of return of a project, if we calculate the IRR of a project, and that internal rate of return is greater than company cost of capital of the project. Cost of capital of the project mean investor required rate of return. Now, for example, I calculate the internal rate of return of a project that is 15%, and the investor is demanding only 10%. If this is the case, then we will accept the project. We will accept the project. We will say, yes, we should do this project. This project should be done. If the calculated internal rate of return is greater than the investor required rate of return of the investors or cost of capital of the company, then the project will be accepted. Otherwise, project will be rejected. Why? What is the logic behind this rule? Look at this graph. Let's assume this is a graph. This is the rate. On this side, we have positive NPV, and on this side, we have negative NPV. This is 0. For example, this is 5%, this is 10%, this is 15%, and so on. If we draw a graph, this will be the graph. And this red point is the internal rate of return. That means when we will move towards greater rate of return, the NPV will tend to decrease. And the rate at which the NPV will be 0, that will be the internal rate of return. Now, for example, if here the internal rate of return is 10%, and the investor required rate of return is 5%. So that means at 10% the NPV is 0, but at 5% the NPV will be positive. So if the NPV is positive, we know that the project should be accepted. So this is the logic. Because if the project is 0, creating NPV at 0 at 15%, then it means below 50% the NPV will be positive. Below the IRR rate of return, the NPV will always be positive. So that's why the project should be accepted. If the calculated internal rate of return is greater than investor required rate of return or cost of capital of the company. This is the decision rule of the NPV method. This is the concept which I have delivered to you. I'm not discussing at the great extent. We will discuss this concept later on, but this is the basic of IRR. That IRR is the rate at which NPV will be 0. This is the estimated rate which we will estimate for the purpose of decision making of any project. And this is the formula which we will use manually if we have to use in multiple choice question. We will apply this formula later on. And the decision rule is that if the IRR is greater than the calculated IRR which we have calculated for the project, if that IRR is greater than cost of capital of the company, investor required rate of return of the company, the project will be accepted. Otherwise, project will be rejected. So if, on the other hand, if IRR is 15%, but cost of capital, for example, okay, just a minute. For example, IRR is 10% and cost of capital of the investors or a company is 13%. That means the NPV will be 0 at 10%. So when we will move away from the 10%, away from the origin, the NPV will be negative, and at negative NPV project should be rejected. So in this case, if this is the case, project will be rejected, where the IRR is less than cost of capital of the company or investor required rate of return of the company. You get it? Okay. Okay, students. Now we leave the class here. Now in the next class, we will discuss the IRR further, and in the next class we will we will start to conduct the practice session as well of the topics which we have completed till IRR. We will do the practice question, including OT question, OT case studies, and constructive long question. Okay. So goodbye and take care. See you next week.